Welcome. In this video, has HBAR Coin started to attack? We will analyze this. Don't forget to subscribe and like, and please watch to the end to understand. The breakout of a descending trend can be considered a significant development from a technical analysis perspective. Such breakouts often lead to the establishment of a new market direction and create new opportunities for investors. After the breakout of this trend, market participants' perceptions may shift, and many may view this as a buying opportunity. However, there are several important factors to consider following such a breakout. First, the price movement after the breakout is crucial. If the price moves in a way that confirms the breakout, meaning it finds support consistently above the breakout level, a new upward trend is likely to begin. At this point, investors may expect the price to continue rising. However, it is also possible that the price could pull back immediately after the breakout. This could indicate a false signal, suggesting that the market may return to its previous direction. Therefore, it is essential to carefully monitor the price action. Another common occurrence after a trend breakout is that previous resistance levels often become new support levels. This can be clearly observed during retest movements that occur near the breakout point. If the price retests the previous trend line and reacts positively from there, it could confirm the validity of the breakout. In this case, investors may open positions above the previous resistance level, anticipating that the upward movement will continue. This strategy can help investors make more solid, well-founded decisions in the market. Additionally, breaking an important resistance zone, along with the breakdown of the previous descending trend, can change the overall market psychology. For a long time, the price has been under the pressure of this descending trend line. Breaking this pressure could be perceived as a positive development by market participants, potentially leading to more investors entering the market. This could increase liquidity and allow for a faster price rise. However, not every trend breakout guarantees an upward movement. Investors should carefully monitor market movements after the breakout and avoid assuming that the price will only move in one direction. A short-term pullback following the breakout is quite likely. This pullback can be considered a retest movement. Such movements are necessary for the market to continue in a healthy manner. Rapid and sharp upward movements are often unsustainable, and the market may feel the need to correct. Another crucial point is the relationship between volume and the trend breakout. High trading volume is a strong confirmation that the trend has broken and the market has taken a new direction. If the price breaks a trend with increasing volume, it indicates that market participants are supporting the breakout and that the movement is likely to be sustainable. However, a breakout with low volume could be a weaker signal and increase the likelihood of the price returning to its previous direction. Additionally, these technical analysis signals are not only important for short-term decisions, but also for long-term strategies. Investors should not view trend breakouts solely as short-term trading opportunities and must look beyond just the trends. Other metrics should also be considered. Continue monitoring the market. According to the Elliott wave theory, price movements follow a specific pattern, typically defined by 5 waves. These waves are the natural result of buying and selling pressures in the market and reflect the collective psychology of investors. The first and second waves usually represent corrective movements, while the third wave typically represents a stronger and longer movement. In the current scenario, the price has completed the first and second waves and has now entered the third wave phase. The third wave is one of the most important stages of the Elliott wave theory, and typically creates the strongest market movement. During this wave, significant price increases usually occur, as market participants expect prices to rise further and begin buying in anticipation. The strength of this movement comes from the fact that the majority of traders start buying, as the beginning of the third wave often signals a period of rapid upward movement in the overall market trend. We believe that the price is currently transitioning into the third wave. In Elliott wave theory, the targets for the third wave are typically determined using Fibonacci levels. These levels are used to identify potential future target prices based on past price movements. In this case, we can mark the 1/618 Fibonacci level as the minimum target for the third wave. This level usually indicates a zone where a correction is expected to occur after the completion of the third wave. However, reaching this level is not only a target, but also a potential turning point in the market. The 1/618 Fibonacci level is considered a critical level according to the principles of Elliott wave theory, and is typically found near the upper end of the third wave. After reaching this level, a short-term correction in price is expected. However, this correction is generally brief, and the market is likely to prepare for another upward movement. For investors, this turning point could provide opportunities to enter positions before or near this level, anticipating further price increases. Fibonacci levels are a powerful tool for understanding and predicting the natural cycles of the market. The 1,618 Fibonacci level is often analyzed alongside the support levels formed by the first and second waves. If a pullback occurs at this level, the correction wave may be short-lived, and the market could continue its upward movement quickly. However, an important point for investors to keep in mind is that the price may experience some pullbacks before reaching this level. This suggests that the price may face some resistance before reaching the 1,618 Fibonacci level. The completion of the first and second waves generally indicates a short-term correction period in the market, and when the third wave begins, the market typically shifts into a buyer-controlled phase. During this period, as prices move upward, investors are more likely to continue buying. The third wave is when prices tend to rise the fastest. Additionally, when the price reaches the 1,618 level, some investors may choose to take profits, which could cause the price to pull back in the short term. However, such a pullback is usually brief, and the market will likely resume its upward movement. When the price reaches the 1,618 Fibonacci level, it may act as a resistance point. This resistance level could become a key factor in determining the direction of future market movements. If the price breaks above this level, higher Fibonacci levels may be considered as new targets. These levels suggest that the market could begin a much stronger upward trend, possibly initiating a larger movement. However, investors must be cautious when dealing with the third wave and Fibonacci levels. The market can always move in the opposite direction of expectations, which is why risk management is crucial. As the price approaches Fibonacci levels, a significant price movement could occur, but the magnitude and direction of this movement are not always predictable in advance. Investors should trade carefully in areas near these levels, limit their positions if necessary, and manage their risks effectively. The Elliott wave theory asserts that market movements always follow a certain order, and this pattern can help investors develop the right strategies. When the third wave begins, prices are expected to rise rapidly. The 1,618 Fibonacci level is one of the key target points for this wave. However, once this level is reached, prices may experience a pullback. Therefore, it is important to proceed with caution and prudence. The head and shoulders, H and S pattern observed on the chart, is a strong formation that indicates the potential for a market reversal from a downward trend to an upward movement. This pattern typically occurs after a downtrend and signals the beginning of an opposite move in the market. The head and shoulders pattern consists of three main components: the left shoulder, the head, and the right shoulder. The price falls to the head region, and then a recovery tends to start at the right shoulder. At the end of the right shoulder, the market may break through the neckline and start moving upward. Currently, it is observed that the price has formed the final shoulder and is beginning to break the neckline. If the price successfully breaks the neckline, this can be considered a clear signal of a market reversal. The breakout of the neckline is a critical step for the price to begin moving upwards. This level's breakout is generally viewed by market participants as a strong buy signal. However, a few important factors must be considered for the pattern to reach its target. First, the target of the head and shoulders pattern is calculated based on the depth of the head. The depth of the head represents the distance between the head and the neckline, and after the breakout of the neckline, this distance indicates the potential upward target for the price. Calculating this target helps to understand the potential direction of the market. If the neckline breaks, it is quite likely that the price will move toward this target. However, this does not always imply a linear movement. Market dynamics can sometimes cause the price to experience a few corrections or pullbacks before reaching the target. There are often situations where the head and shoulders pattern creates strong support. Specifically, if the price approaches the neckline several times before breaking it and then pulls back, it shows that the market is testing this level and has the potential to break it. If the price gets stuck below the neckline a few times and then moves upward again, this can be an important signal for investors. Furthermore, if trading volume increases during these pullbacks, it suggests that there is strong buying pressure at this level, and the breakout, once it happens, is likely to quickly test the target. Another important point is the trading volume that occurs during the completion of the head and shoulders pattern. An increase in trading volume during the breakout of the neckline is a critical factor for the price to move toward the target. If the breakout occurs with high trading volume, it indicates that the market has gained significant momentum, making it more likely that the price will reach its target levels. Trading volume is often a key indicator reflecting market participants' sentiment and confidence. A breakout that occurs with low trading volume can sometimes be misleading and may lead to short-term corrections. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.